Nick Hiersche. I am the president and founder of the Mortgage Calculator. We are a lender that specializes in non-traditional financing. We are licensed in 15 states for traditional mortgages, and we can do non-traditional mortgages that we'll talk about here in a minute in almost every state for our investor clients. So I'd like to thank everybody for joining us today. I have my co-host with me, Jose Gonzalez, with 27 years of experience as well. We'll talk a little bit more in detail. But I'd like to just kind of introduce the rates for today, as we have over 100 banks and partners that we work with in order to find the best deals for our clients. So we've built a quick pricer that we can go through. Just keep in mind this pricer only has about 25 of our 100 banks and outlets that are instantly priced every morning. But this is a great way we can check out these kind of the state of the industry every morning and just kind of go over the details. So let me go ahead and share my screen, and just like we do every day, we'll go over a couple basic scenarios just to check out what the rates are looking like today. So we typically do a 80 LTV purchase. You see the loan amount is going to be $400,000. It's about average for here in Miami. Desired price, this is basically, do we want a no cost rate, which is 100. I'll typically usually have my clients buy it down a little bit, especially in today's market. So for this example, I'm going to use 99, which means we're going to look for a rate that has about a 1 point in discount cost. We're going to look at a conforming option, purchased, 30-year fixed, pretty standard option, what everybody's pretty much used to. Primary, single family, 1 unit. Use our office location for this example. And for our example purposes, we're going to stick with a 760 FICO and a 40 estimated DTI, just so we can compare a few different examples. So this will be our basic scenario, and we'll just compare across a few different programs that we have and just check out what's going on. So here, this is our tool. Again, this is only for mortgage professionals. If you need to actually get a real quote, please get with one of our licensed loan officers. We have over 300 licensed loan officers, as I mentioned, in 15 states that can help you out. Let's go ahead and, oh, you guys can see this is actually live, so it's actually making me do a security check. And I think I'm good there. Oh. Okay, got me through. Boom. Okay, so you can see here are some of our conventional options. So for about 1 discount point in cost on this loan, we have some options from about 6.25. These are for Home Ready and Home Possible programs, which are programs from Fannie Mae and Freddie Mac for conforming loans that comply with some different kinds of regulations, typically median income. So let's just quickly scroll down here to a standard that doesn't have sort of the special designations. And we can see here one of our first options for regular is right around 6.5% rate as of this morning, and right around a 1% discount point here. You see this is actually probably a little bit better option for us here. But there's a lot of great options. And you can see we have hundreds of different banks that we work with that have various options. They're all around the same pricing, but obviously some of these get a little bit crazy when we talk about alternative documentation, which we'll talk about here in a minute. Now, to compare, let's go back to our quick pricer and pull up a couple other scenarios that are very popular. So if a client or borrower doesn't qualify for a conventional loan, we will typically use our FHA option. So these are government programs, basically by the HUD, that allow borrowers who otherwise wouldn't qualify a little bit more relaxed qualification standards. So if someone doesn't qualify for conforming, we'll typically switch to FHA. We'll keep everything else the same for this example. And let's just check out the FHA rates this morning, keeping everything else the same. Now you can see here on the top of the stack here, FHA 30-year fix will be about a 5.75 rate, which looks attractive, much less, but I'd like everybody to key in on the APR. FHA does have extra fees, including mortgage insurance, even if you put 20% down. So there are extra fees and costs associated with an FHA loan, but it does allow borrowers who otherwise wouldn't qualify to get in the action. Now we have, again, all kinds of different banks and partners that we work with. So this appears to be the best combination for about 1% discount for about a 5.75 rate. But there are other options as well, a little bit less cost here for about relatively same rate. And then you'll see here we have just hundreds of other options that we can go through. Specifically, there's some DPA and some other various options that we can go over, which are very specific. 203K programs as well. So there's a lot of different variations within the FHA that we can work with. So please get with one of our licensed loan officers if you're interested in any of these FHA programs. Now, let's go back to the quick pricer. We typically can also price the VA and USDA. Those are special programs. Obviously, VA, you must qualify. So you must be a qualified member of the armed forces. So if you have a qualification, great. Get with one of our loan officers. We can quote that. And USDA is typically based on property. So if you're looking at a property in a rural area, the USDA programs are great. But that's a little less common. So I won't go through that today on the live show. And we'll just move on to what makes us very special here. And that's where we see here this expanded guideline. So what does expanded guideline means? For us, that's what we call non-QM or non-conforming, non-traditional mortgages. These were typically had a bad name, but you guys may be more familiar with these as such as a bank statement loan. So that's typically our most common request for an expanded guidelines program for someone who may not qualify for conventional or FHA financing because they may be self-employed, maybe doing some write-offs on their taxes, etc. So we need to use alternative documentation. So the best option for that, when we click through expanded, we'll set everything else the same. We're going to look for a 1 point in discount. We're going to look at a purchase, 30-year fixed, primary, single family, everything else the same. But now when we do expanded, we can switch from a full doc conforming FHA qualification. Now we can switch it to all of these alternative options, which we have a whole plethora of options. The most popular here is the 12-month bank statement. So we typically do those for self-employed borrowers. So we have to click self-employed because only self-employed are eligible for that. But this is typically for like our realtor partners are very common. We do a lot of realtors. We do a lot of people on the gig economy, right? Uber type situations. Anybody that's self-employed can now qualify with their bank statement income to determine a debt to income ratio. So in this case, we're going to use this customer's personal 12 months of bank statements to determine a DTI ratio of 40 in this case, to compare it side by side to what we saw before. So remember, the rates are going to be higher on these non-QM programs, but these are ways to get our borrowers into homes who may not otherwise qualify. So great options for us. This is really what our team specializes in, is all of these different non-traditional options. So please get with one of our loan officers there. This is obviously incorrect there. That's a little crazy. Let's go to the, this is probably a specialty loan. This one actually says bank statement. So let's cue in on this one. So this will be one of our bank statement options for 7.99 rate with a little bit of crazy cost there. So I probably wouldn't recommend my clients that. See here, we have another alternative documentation option from one of our banks that offers at 8.125 for 2 discount points, which is a great, reasonable option. And we can go on and on here for all of these different qualifications. Remember, when we're going alternative documentation, it's a very different, atmosphere there. So please get with one of our licensed loan officers to navigate which ones of these programs works best for you. So realtors might work better for one program because of a certain thing. We might use one, bank for another thing, but there's all kinds of options. So we have plenty of options here. It looks like from 8.125, and we can even go higher. You see this 8.625 has a lower discount point. So just a ton of options here using these alternative documentation. So you see all these options, they go up in rate. Obviously, these are specialty programs that may have little loopholes for different people, but there's all kinds of different options here from all of our partners. Again, we have over 100 banks and partners we work with. This is only about 25 or 30 of them that are offering all these programs in our instant pricing system. So these are great options for our borrowers. Remember, we can do other options as well. So when we click on expanded, we can also do 1 year documentation. We can do 2-year documentation. We can do asset related documentation. So that's if you have a large asset account, you don't maybe are in between jobs, but you have $1 million retirement or something like that. We can deduce a debt to income ratio by using your asset account and deducing that over a period of time. Every lender is a little bit different. We also have our business bank statements and VOEs and some other things, 1099s, things like that. So a lot of great options for alternative documentation. Please get with one of our loan officers to determine which one's best for you. Now, our favorite part here for me and Jose, now we get to move on to the investors. So today, specifically, I'm going to have Jose do a little example here in a minute, but we're going to focus on investment properties, which is our most popular programs. We work with a ton of investors, and they love to come with us to check out our alternative documentation options for investment properties. We get a lot of requests for short-term rental properties. A lot of people are doing Airbnbs now, VRBO type of things. And we just get a lot of requests for people to refinance maybe their fix and flip or their property that they've held for a while in order to purchase new investment properties. So these are our most popular programs, but let's go ahead and check some out. So today I'm going to have Jose compare in detail what I'm going to pull up here in just a second. So you see here, we'll do a 80 LTV. We'll do 99 on price again. We're going to do expanded purchase for an investment property. And we can do, or actually let's do conforming first. So we'll compare conforming for an investment property, keeping everything else the same. So if someone qualifies for a conforming loan and wants to purchase an investment, that's great. But we'll see here that unfortunately, the GSEs, the government-sponsored entities, Fannie Mae and Freddie Mac that are sponsoring the conventional loans that everybody's used to are charging a whole lot of cost and fees in order for to take on investment properties. So you'll see here our conforming 30-year fix. The best option that we even have is a 7% rate with quite a bit of discount points. So this might even be, this would be hard to pass compliance here in some cases. So I probably wouldn't even recommend this to our borrowers. A lot of times we'll have to go down to 75 LTV if we want to do a conforming loan, just because these costs are pretty crazy right now because the government entities have added extra fees in order to do investment properties. So if you do qualify, these are typically a little bit better, but obviously be ready to pay a lot of discount points. If you don't want to pay a lot of discount points and maybe go with a higher rate, we have those options, and those come with our non-QM. So now that conforming has a whole bunch of extra fees that come with it, we see that a lot of our investors are switching over to the non-QM options for alternative documentation. Makes it easier, faster, quicker, and now much more competitive. So let's check out those options. So whenever we do an investor, we'll typically show them the conforming as well as the expanded options. So most of our investors, if they have documentation, as I mentioned before, they'll probably do a bank statement loan. So just to pull that up here, let's pull everything that we equal to what we've been using before. We'll add a prepayment penalty. Typically with expanded guidelines non-QM, we're always going to add a prepayment penalty when we have an investment property. That's just typically common. The penalty is usually about 6 months interest. Depends on which bank we're using or which investor we're using. It just depends. So again, get with our licensed loan officer. But this is common for non-QM, so don't be too afraid of this. It does open up a lot of opportunities, which you'll see here once I click show. Oops. Forgot to click the option. Hold on. Let me reset it. Remember, as I said before, you must be self-employed in order to use bank statements. So I got to click that self-employed box, which is what I forgot before. So everything is how I want it. So sorry about that. Let me click through. And we'll see we have our alternative documentation options, which is a little bit higher rate. But remember, it's much less discount points and cost to close, right? So for around 1% discount point, we can get 8.625 rate, which is, as you saw in conventional, was about a 7% rate, but almost 4% in discount points. So big difference there. And as you can see, these options are very popular with our investors because they're very close with much easier documentation. Now, the most popular program, the thing that we do most here at the Mortgage Calculator, our specialty, is what we call the DSCR program. So Jose will talk about that in detail here in a second. But let me show an example of what a investment purchase for a single unit property using DSCR, which is a no employment, no income documentation program for our investors. So for investors that are trying to scale their business and scale their portfolio and quickly cash out investment properties and then purchase new investment properties, this is the best option. So we'll have no documentation. We always add a prepayment penalty on the DSCR since this is a commercial type of loan. And since this is a commercial type of loan, we can also do this loan in almost every state as well. So great options for our investors. We love working with investors with properties in multiple states. We can always do those. So this is what it looks like when we do a DSCR option with a standard 3-year prepayment penalty. So you see here the rate's just a touch higher, but actually a little bit less discount points on this one. So right around the same, between 8, 9. Some will even go up to 10 just for specialty programs you see here. But we just have dozens of different DSCR programs that just vary in their qualifications. So please get with our loan officers in order to check that out. Remember, DSCR is only based on the rental property, so it's only going to be based on the rental property income. So some of these will work, for example, for a short-term rental property because we can do some fancy things with the income qualifications. Some of them won't, right? So if you want to get some of these better programs, please get with our loan officers to explain the different ins and outs of which programs are going to fit for your property. Now, what I'd like Jose to take over here in a second, I'll do a quick scenario here on the quick pricer. Jose is going to go into detail about what we mean here. So one of our most common questions for investors is how can they get a multi-unit property? So this is also, a common topic in investment groups, house hacking, all that kind of things. People trying to buy primary multi-unit properties or just investment properties that are multi-unit is definitely a popular topic. So let's compare here for a second a conforming purchase of a 4-unit investment property, which is very common, right? 4-unit property is the most units you can have before going into the commercial realm. So we still have reasonable programs and reasonable rates and costs here that we can instantly quote. Once we go into commercial land of 5 units and more, that's a custom commercial quote. It takes us a little while to do those. So please challenge our team to quote your commercial deals for 5 or more units, which we do specialize in. We can do up to hundreds of units, no problem. But for these instant pricing and all of the banks that have instant rates available, we can also check out up to 4 units. And we're going to do a conforming 4 units. Everything else is going to be the same. And we're going to compare a 4-unit conforming purchase to a 4-unit DSCR purchase. And Jose will quickly point out some ins and outs of what it's going to do. But I want to really quickly press this button and show you the main difference, right? So we're going to try to do an 80 LTV purchase on a conforming loan for a 4-unit property. And we're going to click show rates. And notice there is no conforming options. So these are some options that we have for non-prime or non-QM. I don't know why they're showing up here. I wish they wouldn't. But the point is there are no government agency programs that offer a 4-unit property for 20% down. So 25% down minimum. So in order for us to get the regular programs, we'll have to slide this LTV to 75, which is more down payment, which our investors don't like, right? And then we'll go investment, and we'll go 4 units, and everything else should be the same. And now we should see some conforming options. Here we go. So here's a conforming 30-year fixed, and you can see the rates and costs are obviously very high, comparable. And remember, this is a 75 LTV, so we went down in LTV, so a little bit better than the 80% single unit as far as discount points. But remember, this is 75 LTV, so more down payment. Investors hate large down payments, so this is not typically what our investors choose when they're purchasing a 4-unit property. They don't want to put 25% down. So in order to please our investors and provide them other options, we can obviously quote that, but we can also still do 80 LTV on a investment property purchase if we do expanded guidelines, particularly if we do the DSCR program, which is our most popular. Just like to show you that we still get a plethora of options here at an 80 LTV purchase for a 4-unit property. Oops. What happened there? Let me refresh. Hopefully Jose has has the example pulled up. I don't know why it just errored on me there. Let me see if I can get it to go. There we go. So you see for the DSCR, we can still do 80 LTV purchases. So Jose will actually go through a detailed example here of what exactly that means and what he's going to explain to his customers in order to expand his LTV options. So let me go ahead and take my screen off. I'll bring Jose in the big screen. So Jose, can you explain a little bit more about how we recommend our investors to take on those multi-unit properties?
Absolutely. As you know, most investors, what they worry about, and you touched on it, is LTV. So I am going to jump right into the quote examples that I have, and I'm going to go first show the 20% down conventional purchase 4-unit property, 2 to 4 unit. That's going to be an easy one. There are no options at an 80% LTV for a 2 to 4 unit purchase, right? Here's our setup. This is going to be the same setup we're going to have. 80% LTV, 800 credit score, 30-year fixed investment. In this case, this is full doc conforming. All right, this is tax returns, this is tax transcripts, this is delays waiting for the IRS to process your 4506. I mean, there's a whole bunch of hair pulling going on here, and still, right, we have nothing. So now we're going to go to the 4-unit DSCR, debt service coverage ratio only, which means no job verification, no income verification of a personal nature required from the borrower. Property is the loan. Basically, the borrower is qualified on the cash flow from the property, 1007 or gross market rent or lease, whichever you have, short-term rental. Divided by your housing expense gives you your debt service coverage ratio. And in this example, 20% down, 4-unit property, $400,000 loan. This is what we have. So we can still get 9.875 with 2 points, basically $8,000, 2 points. And then from there, you're just buying it down. This is roughly 3 and a bit there at 9.125. But remember, this is a 4-unit property, which is definitely, unless there's a big problem here, it's definitely going to cash flow way above 1.0, right? This could be definitely maybe even above 1.25. But in this case, we're looking at 80% loan to value, something that is not doable, not touchable at all on a conforming conventional loan. And this is, again, DSCR, right? So now we will compare 75% loan to value. So now the conforming loan does come into play. So you're looking at the same $400,000 loan. So at a 7%, you're looking roughly 2 and I think it's 2.625. I think this number right here, which is the lowest cost. And by the way, this was from only one investor. Everybody else was substantially higher in rate than these people right here. So this is 2.625 points in buy down. And again, this is full doc. And again, this is conforming, where again, you're going to be limited. In this example, we're doing a pretty low price for a 4-unit property. So I know that the conforming limits have gone up, but that's something that you may be faced with, depending what market you're in, that you may not be able to get that 4-unit for within the Fannie or Freddie conforming loan limits. But now to put this into perspective, we go for the 4-unit DSCR. Yes, the rate's going to be a little bit higher, but not that much higher. I'm going to do a switch back in a minute, but I want you to absorb these numbers. 7.375 is costing 11,719 buy down, right? And in this example here, 7% is 10,500. So there's not that much of a difference in the buy down, but there is a prepayment penalty on the non-conforming as opposed to the conforming, and there is a loan origination of 1% on the non-conforming. But still, comparing apples to apples, I would probably say that the DSCR at a 75%, at a 7.375%, it's probably going to be a more doable deal than trying to squeeze that full doc loan on that 4 unit property on that investor that could have. I mean, typically when we get these investors, they have multiple properties already. Their tax situation is all over the place, and it usually presents a really big challenge to try to make it work, because by the time they're buying a 4 unit, like, they're already experienced investors. Some of these people have 10, 15 properties, 20 properties, and it becomes very tough to do the loan, and with a real minimal benefit to be obtained between 7% and 7.375. So, usually this ends up being a DSCR loan. But where most of our investors, I mean, this is good comparing apples to apples, or at least at a 75%. But most of the investors want to maximize their property purchases. So they're usually going to want to hold on to their money, and they're usually going to want to do this option, even if it is a higher cost, even if it is a higher rate. To them, it's all relative. It's about getting 2 properties and leveraging themselves out and getting a bigger benefit that way than getting the 1 property at the 75%. They would rather get the 2 properties at the 80%. And mind you, this is for a 4 unit property. If we were doing a 1 unit property, we could go as high as 85% on the DSCR, as long as the property is cash flowing at 1.25 DSCR, which, there are a lot of properties that do that, especially at the lower price points. They are going to DSCR above 1.25, and then you're going to get an 85% LTV, no mortgage insurance, and then they're definitely going to be able to buy the 2 properties instead of 1 property, because the cash outlay is going to be much less. The investors really see the value here. I mean, you may get the random scenario where they're going to go for the rate and maybe go for the 75% LTV on the conventional loan if it is a lower price point, but 9 times out of 10, they want that 85% on the 1 unit, and they want the 80% on the 4 unit.
All right. Let's go ahead and pop this off. Well, thank you, sir. We had a few questions here in the chat. Let's see if I can overlay this. It doesn't show the old comments. Well, you see, we had a chat here about down payment assistance programs. We do offer down payment assistance programs. Those are typically under FHA. So we do work with quite a few partners that offer DPA programs. So that's an option. Typically, we try to stay away from those, and especially in this market, it becomes a little difficult to do those DPA programs specifically. But if you have a customer or yourself that needs one, please get with one of our loan officers. Again, we are the Mortgage Calculator. We are a licensed mortgage lender in 15 states for primary and second homes. And then we can also do our DSCR commercial loans in almost every state out there for our investor clients. So if you guys want to go over any of these programs in detail that myself or Jose talked about, please get with one of our loan officers at themortgagecalculator.com. You can even price our commercial DSCR programs yourself if you're an investor out there curious on some of them. But again, please get with like Jose, who can go through all the details, send you those quick quotes, nice and beautiful, run through the different rate options. When you use the quick pricer, it's just kind of to give you an indication like we did this morning. So please meet up with one of our loan officers, and they will get down to the nitty gritty. And in about 5 minutes, they'll send you a plethora of options for you. Well, thanks, guys, for joining us today. And we'll be back tomorrow again with another Daily Mortgage Rates Live. Thanks, everybody.
Thank you, everybody. Have a great day.